got the list of them.
John, the
We're
really close to the Fed decision. 1 minute away.
The tariffs and Hershey's were jaw.
You're trying to keep us in line.
No, the tariffs. Bob, help me here. This is a real deal. These tariffs coming in here is a revenue gain for the country. They're beginning to add up.
They are. They're going to be trillions of dollars. All you have to do is look at the CBO scoring methodology, and it almost perfectly offsets the incremental spend of the One Big Beautiful Bill Act.
Bob Michael's going to be sticking with us. The decision is about 30 seconds away. So here's the setup. Most people, no, almost everyone, expects no change in monetary policy in about 30 seconds' time. However, there are some people who are expecting some dissent. One governor maybe. If you get two governors, it will be the first dissent against the chairman, going all the way back to 1993. The decision, moments away. Equities are positive by 0.25% on the S&P 500. On the Nasdaq 100, up by 0.4. On the Russell, up by 0.9. That decision seconds away. 30 minutes later, Chairman Powell. For now, let's cross over to Mike McKee.
No rate moves, two dissents as anticipated, and no future guidance. The benchmark rate remains in a range of 4.25% to 4.5%, even though policymakers say that economic growth moderated in the first half of the year as, quote, swings in net exports continue to affect the data. Uncertainty about the economic outlook remains elevated, their statement says. They dropped the suggestion in the last statement that it had diminished. But there are no hints about future moves. September is not mentioned in the statement. There's no change in their line about carefully assessing data, the outlook, and the balance of risks in considering the extent and timing of additional adjustments to the target range. At the moment, labor market conditions remain solid and inflation remains somewhat elevated. Those were the characterizations used in the last statement. As anticipated, Governors Chris Waller and Mickey Bowman dissented the first time, as John mentioned, that two governors voted against a committee decision since 1993. They preferred a 0.25 percentage point cut. Governor Adriana Kugler did not attend the meetings or vote on policy. The Fed says she is attending to a personal matter. Guys?
Mike McKee, appreciate it. Fantastic breakdown, as always. As expected by many of you, policy unchanged. Two dissents, two governors, as Mike repeated, the first time since 1993. In the first paragraph of the statement, the committee says the labour market remains solid. This is the issue that Governor Waller has with the labour market and that kind of communication and language. When he made the case to cut interest rates in the last few weeks, he thinks this is a labour market on the edge. Ultimately, at this meeting, he failed to convince the rest of the committee to go with him.
Although he did get another Fed governor, and I am curious to see what their justification is, especially after the ADP report, the better than expected GDP print, a whole host of other economic data points that have come out, as well as earnings that have continued to surprise to the upside more frequently than not. This is going to be very much an emphasis on why from their perspective.
I don't agree with the 3% statistic today. I think we're at 1.2% domestic final sales. I love what Jason Furman did with a 6-month moving average. And you mentioned, Bob Michael, Feroli's at a 0.75 forward. I think the numbers are soggy. They were Trump-affilic numbers.
Let's look at the market. Equity is still positive, but fading, up by 0.2% on the S&P 500. In the bond market, yields just a little bit higher. Look across the curve on a 10-year up by 2, on a 30-year up by 3. The price action could get mixed up in about 28 minutes' time when we get this news conference with Chairman Powell. With us around the table, Bob Michael of JP Morgan Asset Management. And Bob, I want to come to you first, because ahead of this decision, you weren't just banning away those two dissents that could come on this committee. You said they were important. Why are these two dissents important this afternoon?
It's got my attention for sure. If I go back to December 1993, you had Wayne Angel and Larry Lindsay dissented. They thought policy was too accommodative. You know what? They were right. In January, the Fed came in and started a year-long doubling of the Fed funds rate. When I look at Waller and Bowman dissenting, they're seeing something that's meaningful enough for them to be the first Fed with two dissenters in over 30 years. You have to pay attention to that.
It's going to be really compelling to see how Fed Chair Jay Powell messages this afternoon in about 30 minutes' time when he gets to that podium. Yeah. What are you expecting him to say to explain why they were unable to convince the rest of the committee and whether he has lost control over the majority of the thought?
Well, I think he likes to be a consensus builder, so I expect at the press conference he'll try to close the gap and say there wasn't much disagreement in actuality, that if you look at the last summary of economic projections, we had 2 rate cuts in there going into year end. The timing of that was always uncertain. We had a couple governors who felt maybe we should be pulling it a little bit forward. The rest of the committee thought we needed to see a little bit more data, but we're all on board with a rate cut or 2 before year end.
This just in from Neil Data of Renmac. Waller and Berman dissenting tells you the FOMC will eventually move in the direction of the dissenters. Let's extend the conversation. Jim Bianco of Bianco Research joins us now for more. Jim, welcome to the program. Just first of all, your reaction to the statement and the dissent of the FOMC.
The statement and the dissents, I think, were as expected. There's really not a whole lot to be surprised about it. Maybe that Mickey Bowman did it, but I'm not shocked that she did at this point. Waller, I think, is going to have an interesting case to be made when the blackout is lifted on Friday as to why this is not an audition to succeed Jay Powell, and as opposed to being an economic case to really cut rates.
You said that you're less surprised about Mickey Bowman and that actually that's less of a preeminent concern for you. And yet she was the dissenter last September when the FOMC did cut rates, and she said she didn't think that they should. Does this seem a bit like an about face when it comes to her approach to monetary policy?
It might be. It might be in terms of the way that she's been looking at the economy lately, and it's been a bit, in at least my read, somewhat inconsistent, but not a whole lot. And so, yeah, it does kind of have that feel that it's an about face.
Jim, you're a trophy taken. You were one of the first ones there saying inflation, sustained inflation, we're not getting the disinflationary vector. I want you to revisit that right now, given 2 dissents, given the understanding of a slowing economy. Are we still going to see persistent inflation?
I think we are. I've been using the case that whenever you have a recession or a financial crisis, and we had both in 2020, that the economy fundamentally changes. And if you want examples of that, deglobalization and remote work are probably top of the list. This is not the 2019 economy. I know Chairman Powell likes to say that we see broad signs that the economy is normalizing or returning to pre-pandemic levels. That's another cycle. We're in a different cycle right now. And this is a cycle of elevated inflation. I think that the inflation rate is going to run around 3%, maybe as high as 4%. But I like to caution that I did not say 8-10 or Zimbabwe inflation. And with that type of level of inflation, and that's largely what we've seen, we've averaged over 4% in the last 5 years on the inflation rate, that the appropriate level for the funds rate is about where it is now. And the Fed should not be talking about cutting rates when you've got all-time highs in the stock market, in housing, in crypto, all the way down the line. I don't know what problem they're trying to solve that they think that they need to give us easier money.
Add on to that, Bob Michael, as you can. Synthesize all of J.P. Morgan about the nation's productivity, our technology overlay, and the persistency of inflation Mr. Bianco talks about.
Yeah, I think Jim's on to something. And if I were on the Fed, I'd be worried that corporate America is bottoming in here. They're learning how to absorb tariff policy, so they're pausing on a lot of things. But once we get through this year and head into next year, they'll start spending again, and we'll be left with a labor market that has unemployment, call it in the mid-4s, but we don't have the immigration coming in. So now you've got a labor market with unemployment in the mid-4s, corporate America starting to pick up a little steam again and starting to hire, and you're back to tightness in the labor market. So I understand where Jim is coming from. It's something that I worry a lot about. We'll see what happens over the next couple of quarters.
Based on the conversation you guys are having, though, the Federal Reserve's got a problem, because the way the Fed has communicated under Chairman Powell over the past few months is that the only reason they're not reducing interest rates is because of the tariffs. He's not talking about any of the things that you're talking about.
Yeah, and it's good cover for now to say tariff policy is one of these transitory inflation impulses. That's probably true unless it becomes embedded in wages, unless we get into the first half of next year and we find out the labor pool is actually tighter than we thought, and without the immigration inflow, suddenly existing workers demand higher wages. That's a wage price spiral I would worry about. That's putting a lot of horses and
Sure.
carts in front of each other right now. I get it. But it's also a good reason for the Fed not to rush to cut rates right
So,
now.
Jim, you were taking us there. I just want to squeeze in a final question with you, sir. Just how messy this September meeting might be. It might be easy to get through this one. But when you get to September, how much of a mess will it be in a few months' time?
I think it could be a big mess. I think that the data is not going to be consistent for the Fed, what they're going to be looking at. There's an argument to be made that there's a residual seasonality in CPI data that's going to show up in the second half of the year and push it higher. That will give them pause to want to cut rates. I think that the president, again, within the last hour, has pretty much laid on the law that he expects them to cut rates in September, or he might wind up having to take action himself, whether or not that's appointing another chairman to replace Powell or to actually consider firing him. So this is going to be like the last, quiet meeting. I think when we get to September, it's going to be a much different ballgame.
Hey, Jim, thank you, sir. Jim Bianco there of Bianco Research. Thank you very much. Reacting to the Fed decision just moments ago. Policy unchanged as widely expected. 2 dissents from 2 Fed governors for the first time since 1993. As Jim just said, this meeting could be the easy one. The next one gets a whole lot harder.
All of a sudden, you're expecting to see that inflationary impact from the tariffs that will trickle through in a more meaningful way. A lot of analysts saying you just have to wait until the third quarter and fourth quarter to start seeing that, because Hershey's is getting more expensive as they expect tariffs to roll through. This really is the question. If you're not seeing significant weakness in the labor market, how do they justify it?
The news conference, 20 minutes away. Diane Swanker, KPMG, joins us now for more. Diane, welcome to the program. How is Chairman Powell going to navigate this one?
Well, I think one of the key issues that we haven't talked about yet is the implied PCE index, which the Fed targets, which was in this data today. And that suggests what was in the data today suggests before revisions, we could see an 0.5% core and overall PCE index, the highest core PCE index at 2.9% since March of 2024. That is not a number the Federal Reserve wants to see. And that's ahead of the full effects of tariffs kicking in, which takes 6 to 18 months. And so we're going to start to see more of that tariff-related inflation. The inflation, by the way, today, the acceleration was in both goods and
Yo, what's going on, family?
For the Federal Reserve, because it suggests that
let's do a mic test.
There may be some contagion from tariff inflation from goods tariff inflation into service sector inflation. And that is exactly.
Do let me know, guys, if you can hear me,
on the Fed,
because there's a lot to get through today. Some crazy news that I've got coming up as well. But I'll share that with you in a second. Let's get through this thing.
How much the bond market's going to start to worry about.
Loud and clear. Amazing, brother. Thank you so much. Yo, JP's in trouble today. No matter what happens, Fed Waller is waiting in the wings. And I'm not even excited for the rates decision. We knew what that was going to be, guys, right? Patriot, big up yourself. Nice hat, Pratik. Thank you, brother. But it's not about the rates today. It's about the press conference, because JP is in trouble. Jojo's flying. Exactly. Rob, that is absolutely true. And I'm going to tell you the reasons why Jojo's doing nuts. And that's and there's way bigger announcement for Jojo to come. Red hat means the opposite. Pratik. No, brother, it means completely the opposite. Red line, red line, green line, red light, green light kind of thing. So I'm thinking it's completely going to be the opposite. But it doesn't even matter, to be honest, because what matters is what's going to happen in September. Trump just tweeted on Truth Social, which is absolutely insane, that he's hearing rumors of a potential cut in September. He's spilling the beans. This is where and when dementia is helpful for the markets. Trump is just unbelievable. He just dropped the beans, man. Literally, he just said, yo, I heard some rumors that they're not going to cut the rates today, but they are going to cut the rates in September.
Diane, just on these dissents, how convinced are you that these are credible?
And major dissents within the Fed.
Auditions for the chairman's job.
So, yeah, let's have a look at
I
this.
actually think Waller is a very credible economist, and certainly
Yeah,
there's a lot
Fed
of
Waller.
politics at
Let me
play
just
here,
turn this bit up
but
because I think this bit
really
is
sincerely worried about the strength of the economy. You can hear it in the cadence of his voice. I've spoken with governors of the Federal Reserve. I think he's very, very concerned about where the labor market is. And he has some credibility within the Federal Reserve Board of Governors because he looked at the overshoot on job openings and said, we can get a soft landing out of this. And now we're on the flip side of that where he's saying, listen, the labor market stuff is saying that it could be much weaker and demand has weakened. The question is whether or not, I don't think it's a one-time bump, and I don't agree with them on that, but we won't know until we get there. And that's where the uncertainty within the Fed is. And I think it's interesting that uncertainty came back into the statement as well.
You'll have to forgive me for following up, but the obvious response to what you just said, Diane, all of those nice things about Waller, nothing about Governor Bowman. Why not?
Governor Bowman is more
a press conference, guys, 15 minutes.
She's not as much an economist. She doesn't carry the same weight on her economic analysis as Chris Waller does. It's just plain.
Like I said, major announcement coming for JoJo, guys. Are you able to hear the audio of the commentary? Do let me know. I know you guys can hear me, but do let me know if you could hear what's being said on the screen.
Mike, you've had a second look at the statement as you go into this news conference in 15 minutes' time. Mike, I imagine you're starting to think about questions to ask the chairman. What kind of questions do you want answered this afternoon?
Thank you, bro.
Well, I think one of the most important questions, John, is going to be whether anybody else on the committee, even if they did not vote,
yo, big boy in the building,
agreed.
Major announcement on JoJo, bro.
Is there more?
That's insane.
In the Fed towards
Crypto G in the house, as always, my brother.
We also want to know.
Hope you're doing well. I haven't seen you for like a month now, bro.
Is it unemployment?
Big shout out to Crypto G, an absolute legend. Thank you for that, Joey.
Anodyne, not changing.
Yeah, that's interesting, bro. He's going to be dovish.
Of either one this time. The big picture that we're missing right now is the labor market because it's still, as they say, solid, but that's backward-looking data. We don't get the latest until Friday. The inflation numbers, as Diane mentioned, we can also already pretty much calculate, and we know it's going up. The GDP numbers today, one question is the business spending numbers were dismal.
So me and Gia have been chasing a bunch of scammers out of the crypto market lately. We've been bombing, you know. Big up G, man. You know, a real one. Absolutely fantastic channel, guys. G, if you haven't been to Crypto G's channel, please take a look and check it out because he is absolutely brilliant and exactly what the space needs.
The most entertaining thing about this is 2 dissents, then this is a boring meeting at the Federal Reserve.
There is not going to be anything boring about this press conference because Fed Chair Jay Powell has to message why this committee that has been noted for its consensus suddenly is breaking apart and why people believe that there is a shadow Fed, effectively, a shadow Fed chair in the likes of...
Another legend in the building. Let me give a big shout out to the game of cryptos. My brother, we've been trying to do like something together for a while, bro. But guys, check out the game of cryptos as well. He's a very good friend of mine and a friend of the channel, of course. But again, an absolute legend. So yeah, thanks for coming on here, bro. And big shout out to you, man. Yeah, let's do an AMA together soon.
I think tariffs are an unknown. The rollout has been uneven. There's more of them coming on Friday. We know the effective tariff rate is lower than it actually should be right now, and that's because firms are using bonded warehouses and free trade zones to not have to pay the upfront cost of tariffs. But over time, we're starting to hit a tipping point.
Grab a bag of JoJo. We know why.
That's what you're seeing in their surveys. They're seeing that the effects are starting to come in and coming off the heels.
Absolutely, bro.
The pandemic-induced inflation, which frankly we have yet to fully
bring down. Bro.
That is important as well, because that proximity, as Jim pointed out earlier in the show, this is a different environment than it was in 2019. And that proximity to that inflation that is still with us from the pandemic, that's important.
I guess the dynamic of our nominal GDP, our animal spirit. You mentioned stagflation, but if I got real GDP coming down, I don't know what inflation's going to...
By the way, guys, just to give you the context, we've been saying, of course, in the DXB Discord, in my macro analysis, that there is a massive kind of disconnect between Fed Waller and, of course, Chairman Powell and the rest. There is a dissent within the Fed on exactly how to approach this. Last month, Waller came out and said he called for a rate cut and other means of reducing the current pain, especially on the housing market. You have to remember that as well. So within that context, when you consider Trump, the drama that's going on with the Fed, the stuff that he's putting out right now, and of course, this discourse since 1993, the Fed has been united since 1993, guys. So the alt season is going to be interesting to see what happens. I'm not here for today or tomorrow. I'm here for the cycle. But September is going to be fireworks for sure. And yeah, let's get to this press conference because we want to see his body language, of course. There's going to be tons of questions and there's going to be some wild swings either direction. Okay. So yeah, let's stay locked in.
They still believe the labour market remains solid. On that market, some data still to come. This is the runway going into the Federal Reserve's next meeting. That meeting on September 17th. Payrolls, August 1, September 5th. CPI, August 12th, September 11th. In between, Jackson Hole, August 22nd. And Bob, you've said repeatedly that maybe Jackson Hole is the opportunity to have a little bit of a reset. Do you think that's still the case?
I think so. I'm still surprised that there were two dissents. Not totally surprised, but I would have thought with Jackson Hole a month away, you could have gotten Bowman back in the tent with everyone else and just gone with one dissent. That would have been okay. I think this is a very important historic Fed meeting.
Well, let's get to the nature of that dissent. Governor Waller articulated this pretty clearly in his last speech. It was quite literally called making the case to cut interest rates. And in that speech, he talked about not just the labour market, saying it's on edge, but also on inflation, that a large share of tariff increases won't be passed through to the consumer, plus any increase would fade over the next year or so. What is it about that argument this afternoon that's just unconvincing to the rest of the committee?
Well, I think Diane actually phrased it pretty well. We're all expecting some level of stagflation in the second half of the year, but we don't know the magnitude or shape of it. We don't know if it's going to be more stag than inflation or more inflation than stag. And until you see that, why go ahead and start changing monetary policy now? You've got corporate America kind of where you want them. They've paused. They look healthy. When we look at second quarter bank earnings, they actually release credit reserves into the system. There's a lot of money sloshing around the system. You look at M2, it's over $22 trillion. The reason for the Fed to start guessing 3 to 4 steps ahead to bring rates down today just doesn't make sense to me.
Aditya Bave of Bank of America agrees with you. He joins us now. Aditya, welcome to the program. You've got no cuts for 2025, no cuts at all, and you're not alone. So just articulate the reason why and whether this afternoon's communication ultimately just reinforces your view.
Good afternoon. Thank you for having me on. So I think at the core of our view is what's going on with inflation. And there's this endless debate about the effect of tariffs. But let's not forget where underlying inflation is. This does not get talked about enough. In the last 18 quarters since 2021, how many times have we been below 2% Q over Q annualized on the core PCE? Never. In the last 18 quarters, how many times have we been below 2.5? Just 3 times, and most of that was used cars. So underlying inflation for us is stuck at 2.5%. So even if Waller's right that the tariffs really aren't that big a deal, you still have an inflation problem. And I think the Fed is not still appreciating that enough.
Although you look at, for say, housing, which is a huge component into CPI, Aditya, and prices are actually coming down in a growing number of jurisdictions around the United States. What's to say that there isn't this one-time price pop in particularly consumer goods that will fade, and you also will have disinflationary forces coming down the pike that have really been anchoring a lot of the inflation rates we've been getting?
So per our math, if housing inflation goes back to 3% year over year, which would actually be below where it was before the pandemic, that would take about 20 basis points off of the core PCE, which is why I'm saying that we're trending at 2.5 rather than 2.7%, which is where the rate was as of May. So I still think 2.5, 2.4% is roughly where you're trending, and that's a big overshoot. It's not a small overshoot. That's part of the story, and then the other part of the story is just the resilience of the labor market. Of course, if the unemployment rate goes to 4.5% or higher, they will cut rates. I think that's pretty clear. But we're just not seeing that evidence of increasing slack in the labor market.
Given that, Aditya, does it concern you that there were 2 dissents by governors for the first time going back to 1993 amid a pretty heated political environment for the Fed?
The reality is that this is a very divided committee, and I'm sure Chair Powell understands that, but that cuts both ways. Let's say he were to capitulate to the dovish dissents and cut in September without seeing signs of weakness in the labor market, there would very likely be dissents in the other direction. There were 7 FOMC members who did not want to cut rates at all this year in June, right? And I would say that the balance of data since then has been hawkish.
Bob, what's the 10-year going to do through the rest of the year? You take the summation of what we've blathered on about for the last hour. What's the 10-year yield going to do for the rest of the year?
When in doubt, 440. I think we're in a trading range.
Is that stability good for the economy? It must be.
It's really good because it's pretty much flat to the Fed funds rate where you are today. Right. So there's some relief in housing because of that. And I know the housing market
Let's get to the press conference.
A lot, but imagine if you had a normally shaped yield curve once the Fed paused.
5 minutes, guys, 5 minutes, and we'll jump into crypto.
Where mortgage rates would be.
We have parts of America where it is an absolute boom economy. I mean, I was looking north of New York City this week in Bronxville. It's insane up there. Absolutely insane. So I don't, I get it. It's slow in Kansas City. I'm not sure it's slow around New York City. If you sum to the September meeting or Bank of America saying there'll be no rate cuts, what will be that tension then in the December meeting? It'll be historic.
I think what we're going to see is the effective tariff rate settle closer to 20% than 10 to 15%.
So back to 1933 or even further back?
And a few months ago, we were in that 10 to 15% effective tariff rate. Now we're in the 18 to 20%. That is going to hit corporate America. It is going to hit pricing to the consumer. There will be some pullback on spending, and corporate America will respond to that doing what they always do, reduce their flexible cost, which is labor. So I think all of that is yet to come, and that's what the Fed will be responding to over year end.
Aditya Bharve, Bank of America, still with us. Aditya, just before you go, just squeeze in a question on the labor market. We get payrolls on Friday. I went through the range of estimates from 170 at the high end to 0 at the low end. Aditya, what are you and the team looking for, and why?
We're at 60,000 on the headline, but we're at 85,000 on private. And I think that is much more important. What happens with the headline will be a function of how much payback we get for state and local education from the POP in June, right? So set that aside, 85,000 on private. It's still a little bit below consensus, but it's an acceleration relative to June. And most importantly, the unemployment rate. Where will that land? We have that at 4.2%. That's what tells you what the balance is between supply and demand in the labor market. 4.2 or lower, I think, is just fine from the Fed's perspective. If you go to 4.3 or higher, they would get more concerned.
Aditya, we'll let you run. We'll let you get back to it. Appreciate your time, sir. Aditya Bharve there of Bank of America. Fed decision behind us, news conference still in front of us. That news conference starts in about 2 minutes' time. I think we've all got a lot of questions for Chairman Powell.
Yeah, what would it take for them to have enough confidence to cut rates at a time when you have a lot of economists, including 2 Fed governors, calling for that to happen right now? What is the concern about some sort of tariff-related inflation making it that much more difficult in September, even if in the longer term, this is a one-time price shock?
Aren't we all expecting that? Firmer goods prices through the next several months.
The key will be, what is the consumer tolerance to that? If you see weakening and sort of the stag and inflation that Bob was talking about, if you see more of the stag, in addition to the inflation, that will make them feel more confident in cutting rates.
So, Bob, of those 2 reports, jobs versus CPI, if I could say to you, I'll give you them right now, can have the 2 CPI reports or the 2 payrolls reports. What's more important?
I'd take the 2 CPI reports because that's what we're going to see first. We're going to see the impact of tariffs on pricing. Later, you'll see whether consumers accept that and then how businesses respond to that, either consistent demand or fall off in demand. But it's going to be pricing first.
Can I ask you, do you put equal emphasis on both services prices and goods prices, or do you overweight one versus the other?
No, you have to look at both, and you have to see if there's some offset. I think the goods prices are what everyone's focused on now.
In about 60 seconds' time, the chairman walks through that door, he'll stand in front of that podium, and he'll make some comments for the next 60 minutes and face a ton of questions about why they didn't cut interest rates today, how he's handling the dissent. Then Mike McKee puts his hand up, and Bob slipped him an email. What do you want Mike McKee to ask this afternoon?
I think you have to nail him on inflation. If they're so sure that the impact from tariffs on inflation will be transitory, and he said that in the past, why not go ahead and start bringing rates down, 25 basis points or so? Go with the 2 dissenters. 30 odd years ago, the 2 dissenters proved to be right.
Bob Michael of JP Morgan Asset Management. Bob, thank you, sir. Appreciate
Happy to be
it.
here.
Solid question for the chairman in a few minutes' time.
Yeah, and if CPI is the most important, you aren't going to see the consumer tolerance to it for quite a while. Well, that kind of sets up a chicken and an egg, and you don't get either of them in time.
Bob Michael should be in the press conference. The wow statistic today is JP Morgan with a modeled 18% tariff rate. That changes this entire dialogue.
There is a question as to whether we've seen the test just yet. Peter Chiv Academy is making the argument that we haven't had the tariff test. All of that pre-tariff inventory that we've been working our way through, the fact that it's been escalating slowly, and maybe
all right, let's
September, that test is a whole lot bigger. Here's the Federal Reserve Chairman Jay Powell stepping in front of the podium for today's meeting.
Remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right. It's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information. And, I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge, but it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market,
market dumping.
By many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable. Which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because if it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting. all around the table where people were, thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking. And we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't, that you're right, that's what it says. And that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be at some point when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to slightly looser policy.
Red on the day, but on the live bubbles.
Chair Powell, my question is about what have you learned?
Yeah, things are pulling back a little bit now.
The inflation generating and price pass-through process. And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But
crypto's reacting, guys.
I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals. And that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that. And it wouldn't be good if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria. Hi, Victoria Guido with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work. And I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation.
Crypto is reacting to it. Ethereum right now is sitting at 3759 or 3760 or thereabouts. We expected that. It's now over to September, sorry. So what I would say is, let's have a look at some altcoins doing really, really well. The first one of these is Jojo, guys. There is a bit of alpha in our Discord. For those of you who don't actually know what Jojo is a hilarious meme coin that we've made great amounts of money. I mean, right now, everybody who took that call is on a beautiful 10x, of course, and everybody in our community has eaten very well from Jojo, but this is just the beginning. I have some really, really huge alpha concerning Jojo, and that alpha is on the marketing front. Jump over to our Discord to pick up what that is. But really, I'm so happy because if you look at this chart now, every time they say it's all over, it's literally printed us good money. A lot of the community members have made a very good 10x. And of course, as a result, it corrected just like everything else. And now with this major announcement, and it involves huge marketing expense on the New York Broadway for Jojo. So check out the Discord, see what the details are. You will absolutely make crazy returns on that. At least in the short term, it's a good opportunity to buy any dips. Gav said, I'm going to hold on to my bags. Patriot said, yeah, Powell's an asshole. We all know that. I think the thing about Powell is just because sometimes Trump comes across as distasteful, people tend to get behind him. But there is a split, and I've predicted this. I've been saying it in the Discord that overall, the Fed Waller is more of a bull. And if he is to replace, I think he's the front running candidate to replace JP. I think that's going to be a huge thing for the market to price in. But right now, guys, Bitcoin's at 116. We knew this was going to be a tricky situation. Of course, the press conference continues. And right now, the price is looking rather bearish in the short term. In the long term, I do expect, again, we've tapped into that liquidity zone. Again, these are institutional order blocks. These green and red lines is not something that I plot on the chart, guys. This is an order block. So you could see it tapped into that order block. Of course, RSIs are oversold. That is on the 15 minutes. But in a long term, or across the daily, if we come below, I would say if we come below this level here, we may test back this red line to the previous resistance of the all-time high. So that's Bitcoin there for you guys. And surprisingly today, this is, of course, neural AI. And what I like to see here is, this nearly got up to this $4 level, got rejected, but that is a monumental level when you actually look at neural AI. Previous huge resistance here. So if it breaks $4, then I think neural AI is a good bet to have a decent run. You could see that it is facing that resistance there at that $4 level. But it's had, obviously, this is a massive order. This candle here is quite important. And that particular candle, honestly, tells me that there's either an exchange accumulation or some type of a well purchase, because that is a huge candle for neural AI. Huge candle for neural AI. And I think that's a good thing to look at. Of course, as you know, I am an official partner with Nansen.ai. That's why I've been looking at certain money flow changes over the 30 days, whatever. I'm going to continue to give you preference in our Discord, in our VIP group, to actually capture this alpha and use it in a systematic way, because I can see a lot of tokens that have significant inflows, if that makes sense. Okay. New pairs, they've got something called, this is, links are always in my channel description, but this is literally one of the best tools. I believe it's not cheap as well. So, you could see here that, some wallets here have made incredible amounts of money, and smart wallets like these are vital if we're going to make good kind of flips in the future, guys. So I will definitely keep you posted on how that goes. But look at the market, guys. If we go to the live data, right? So these are the live bubbles right now. Again, the market is just reacting to whatever that's going on. Of course, sell the news. We know this FOMC is always about trading exactly what that news is. But overall, I believe the next kind of, what I would say is the next 90 days should determine what type of profits we take, where we see ourselves in the long term, because I am going to remain bullish for the rest of this cycles, with the exception of certain cryptocurrencies. And with those, I have the tools to literally look at the contracts in a detailed manner. For example, if we're struggling with a coin, right? Let's say, for example, we've got, let me take AI Tech, for example, right? Sitting at 4 cents for an incredible amount of time, just under 4 cents now, okay? So what we were able to do, guys, I'm able to share of any, in any context for any project, okay? So the way I will do that is, just have a look here. Solidius AI Tech. Because what happens is, if no one is selling these tokens, right? Like if you've got, for example, if you look at the JoJo chart, you could see here JoJo went on an astronomical daily run here, pretty much from the 23rd of June, topping here on the 4th of July. Bit of a sell-off, and then again running again. Just continuing to grind up in that particular manner. But what I've noticed is, with some cryptocurrencies, especially these older AI tokens, we need to really, really make a decision. We either, we either bring these projects to the channel, we sit down with them, we say, yo, what's going on? What are you doing? Again, I doubt that I've been contacting, like, for example, these guys, I've sent them enough messages to come and sit down with us. But this is the business end, guys. This is when the majority of money is made. 80-20 law, and 80% of our gains will come from the last 20% of the bull market. Happens all the time, every time, and without any exception. So my thinking is this, right? When you look at AI Tech, right, on Nansen. So what Nansen have is something called the token. You could see it right there. Token God mode, right? So we can actually look at holders, right? We can look at holders with their distribution. And of course, we can see the balances increase over time at what price as well. So we can see token price and of course, token balance. And again, as you see here, what's happening is the token balance is the yellow line, right? The yellow line is the token balance. Supply owned by, of course, 77%. So this is pretty incredible stuff in terms of token highlights, right? Like you could see here, of course, 737.55 million is on exchanges. And of course, there are, 334 whales for AI Tech, right? Public figures, because this had a lot of KOLs. So you've actually got just over 5K in public figures, of course, and then 385 in smart money. And then the top 100 addresses, right? This is all vital information, guys. Top 100 addresses have between them 1.57 billion, or 26% of the total tokens. Okay, so you got distribution score here. Top 100 hold 43% overall of the supply. And this is what I love about Nansen.ai, guys. There is no, when archetype, and I know people were defending these scammers, this particular software is so powerful. Like, it just needs a lot of time. So we can see here, right? We can actually look at money flow as well. We can look at money flow to genuinely hold a token, right? You could see outflow and inflow. That's very, very important. And I know you're finding this useful, so smash a like. You might as well give me a like, because I pay a hell of a top dollar to have access to information like this for the community. Smash a like if you can. But what we can see, guys, what we can see is in terms of the token distribution, because AI tech is not only on BNB chain, right? It's also on Base now, although the base size is very, very small. Okay, so what we can do is when we analyze tokens moving forward, I'm going to be deploying a lot of these tools to actually understand certain aspects beyond the average investor's means, and in that particular way, we can actually see big buys, big sells, when they buy, when they sell, all of that type of stuff, all of that type of information. So that's one of the ones that people are struggling with, of course. And through Nansen, I can see here that where the well balances go up or they go down. At this current moment, I would say, smart money here. If you look at smart money, has already traded this token, okay? And the top P&L as it stands from 3 wallets right now, it's only 3.94K in terms of the P&L traders on spot. So there's not a lot that's going on, but you do understand that there's also something called fresh wallets. So the net flows from newly created wallets with their first transfers within the last 15 days during a selected period. So what this is, basically, the last kind of 15 days, there's been a positive inflow of around 645K in terms of the overall wallet balance that came in for freshly made wallets. Okay, so we do have access to that, guys. But like I said, where you can, always take profit. Where you can't, look for tokens that still have relevancy and live in the market. Why, bro said, why the F are they paying for the tax? Because tax is, we call tax haram, brother. Over here in Dubai, we don't have any taxes. This is a tax-free, and this is probably one of the reasons why. Because it's unfair. It's highly unfair to, again, it goes back to the kind of like the system, really. If you're getting your fair share of equity out of a government for public services, then of course I understand. But people are paying these institutions to print money, and that's just ridiculous, right? I do agree with you. They don't cut rates because Trump keeps playing with the tariffs. Once he's done, yeah, you know what? You're right. And I have always said there was a quarterly report that I share. A monthly report that I share, and a quarterly one. But the monthly report that I share, I put down some additional information regarding the economic uncertainty is at its lowest since pre-Trump, pre-inauguration. So the tariffs, or what I call the tariff fatigue, is real. But most investors now, honestly, like the best that I've had in crypto, surprisingly, has been the worst moment for all of us, which has been the last kind of 4 months, or 5 months, 6 months, whenever Trump came in. We had that high in December. We crashed out. We lost all our gains. A lot of people got wrecked post-inauguration, but we knew it was sell the news, inauguration day, right? But we did not know he was going to come up with a meme coin, drain liquidity out of the entire market. I'll tell you what, that Saturday morning when Trump created that meme coin, honestly, man, it was kind of like I saw that 6 a.m. in Dubai, right? Early hours of the morning. I was up all night working. I had a live stream as well. But you couldn't sell a token. Liquidity was completely drained. So he's been absolutely part of our volatility, part of our misery, I would say, up till now. But off the back of Trump, you also have to look at the adoption for crypto. You've got to look at the overall picture. You've got to see what's going on in terms of all the positive. Today, I can legally pay for many things using crypto. Crypto legislation is there. Crypto is going to be banks are running on blockchain now. So there's many positivities that will lead us to one last crazy push. Bro said he's not an arsehole. Remember, Trump came out of the gates talking shit. Absolutely, you can't disrespect any man, especially, when it comes to Trump, bro. Like, it's just insane. I've run out of, I wouldn't say superlatives. I don't know how to describe Trump. As a father with 2 kids, it's insane, man. There's nothing decent about the guy. He just comes and shoots off the hip. For a while, it's refreshing, and this happened in his previous election as well. But at some point, it just becomes chaotic. But yeah, you're 100% right. Every man would kill, basically, to defend his honor, and that's what Powell is doing. But I don't think Powell is the problem. I think the Fed itself, because if obviously all the governors turn up and go against him, at the moment we're seeing 2 that are dissenting. But if they came out en masse, it would have been very obvious, in my opinion. Appreciate that. R9 in the building, the Brazilian Ronaldo, the real Ronaldo, my brother, R9, aka two of my favorite human beings of all time, Nas and R9. And obviously this is Nas, R9. Nasty Esco to Escobar is Nostradamus. Anyway, guys, what was I saying? So yeah, I mean, FOMC or no FOMC, at the end of the day, I do believe we will get one last day in the sun. That's why a lot of you who are kind of distressed at the moment regarding your crypto portfolio, just remember this stuff is all about not really timing even. It's just about staying cool. Because at the end of the day, if let's say you buy into crypto now, well, you've timed it in a way, because there's no better time to be in crypto than now. All the suffering that happened, if you're on the sidelines now, it's a great time to buy any dip, honestly, from here to the possibly next year. Somebody said to me yesterday on the live stream that we may get gaming season on the drop of GTA 6, and I just don't want to hear that, to be honest. That's 2026 May. No, I'm not waiting around for any cycle. This one's actually taking its toll on us. So yeah, wicked guys, we've got an unbelievable turnout, but how many of you have subscribed to the channel? Give us a like and a subscribe where you can. Where you can, guys. What else we're looking at? So in terms of the overall crypto bags, let's have a look. Let's go back to... At some point, I'm probably going to end up fixing the portfolio as well and go back to these to actually recalibrate what this actually means overall. Because I think some of these X's, especially taking the minimum available to me to close this cycle where I can with those 10X's, of course, wherever that seems unrealistic, I'm just going to trade it. And that's how it's going to be. But layer ones look very, very healthy now. They haven't had a run. Gaming is totally dead. So I accumulate gaming tokens when I can, purely because I know at some point the narrative will come round. Same with AI. But AI, you've got to be careful. I think AI, you just need 1 or 2 really good AI tokens, in my opinion. And then after that, you could just simply wait, add to your bags and wait. Bro said, wait, because Trump was playing with the emotional. yeah. Trump's the guy. Nas said, Jojo. Yeah, absolutely. Jojo is actually one of the best performers so far. Does Nansen have smart money trades for meme coins? Absolutely, bro. It does. Because what it will do, actually, the way it works with the way Nansen works is that it will give you it will actually give you money flow for the smart wallets, which is even better than trading meme coins in any other way. And more often than not, these include, you know, early whales that have been in Pepe or, I don't know, Go, TS Maximus, or, you know, the ones that I've seen anyway, you know, useless coin or whatever the coin is, it will give you a nice little money flow indication of when these whales are buying and selling in real time. Bro said, let's have a look. Let me just go through these. Yeah, Powell, we've made no decision about September. We don't want to do that in advance. Absolutely. He's never going to come out sounding dovish in any way, shape, or form. He's never going to do that. I'm going to do this for bro. Tectum. Tectum is at $8 million market cap, right? Tectum is below $1. Just imagine the decline here, which at one point Tectum was, the all-time high was over $40. Mad. Absolutely mental. Right now, their volume is half of their, what is it? It's actually 500K. So I don't know what they're doing. I mean, I don't know. To be honest, I've seen that found a couple of times on his spaces, and I wasn't feeling him. I just felt like the guy was just maybe too aggressive. But they do have, I like the fact that they've dropped something here on the 23rd. This is Global Talk, powered by whatever. Are they in this? So it's either an insane opportunity or is probably a token that's going to zero. And evidence would suggest right now, Tectum, right? Tectum is not looking good, bruv. But they are trying. I mean, again, 17th of July, Tectum AMA featuring this guy.
Fee.
Okay.
We are inclined to like soft node system when we launch, and we launch very soon. We're convinced that nobody should ever pay more than 1%.
Respect.
And the difference between, and just to kind of step back, we need to understand. So
I think, look, you know, never bash down projects for the sake of it. You know, I don't like doing that, to be honest. You know, the guy is trying. Look, 17th of July. I don't know his history, but all I know is Tectum made some crazy money first time round, and it's down 77% from its all-time high, right? 77%, but they are still active. I mean, all I could say is the tokenomics. So 10 million now, almost in circulation, right? I think it used to be 7 million or out of the 10 million. So below $1 right now, it's absolutely insane. But could they pump again? I mean, this was absolutely incredible. This was insane. I mean, was that all-time high was $43. Okay, with a 6 million volume. Because sometimes people don't realize, you know, you've got to see when it went to all-time high, what the volume was, right? And you can see here, it achieved that basically at a $6 million volume, which is absolutely insane. Right now, volume has come down to 500K. So it's all down to many, many things. But I would say, even from a market cap perspective, Tectum is the same. Now, of course, if we look at, let me just check something else here. on, let's have a look at the contract. Selling pressure here is just insane. So it does actually score from an audit perspective. It does score, it's 19 out of 25. Now, of course, let's have a look at why. So this is Nansen.ai, guys. You're never going to see anything like this in any other live stream, right? So smash the like button. That's the least you could do for me. Mint function, ownership risk, not renounced. Okay, creator. What is this high creator balance? Creator wallet holds more than 5% of token supply. Okay, all of these are just flags. Doesn't mean that this is what, this is exactly what's going to happen with Tectum. But if you're not using, like, for example, Nansen or any other kind of super intelligent software, you may not be able to see that. Holders concentration. So more than one wallet, which is normal anyway, sometimes holds more than 5% of the token supply. Liquidity not secured. Again, it is what it is. Again, liquidity not secured. I mean, that's always a risk. Okay. Less than 95% of liquidity locked or burnt, potential rug pull risk. It doesn't happen because the token has been around for a very long time. But when I use Nansen, I'm looking at more data than that's available, in one place. So it scores a medium risk. Of course, it has passed 19 out of the 25 test that it's had. But yeah, that's what's up with Tectum right now. Insane bet below $1. And again, this could either 100x or it could go to zero, down 12% for the day. So yeah, sometimes you've got to be prepared for that. Nothing wrong with that. But like I said, man, they need a charismatic leader. They need to revamp things. They need to, I don't know. But if they want an AMA, please, if anyone's from Tectum is watching, we've got an audience over 1,055 people. Let's see where the split is so I can pick them up. So X is absolutely going off. And of course, YouTube is way smaller right now, but a lot of viewers coming directly from X. But that's the predicament from Tectum, unfortunately. Nothing against the project. It's just, it is what it is, brother. So what's my thesis? Good question, Graham, of having rate cuts in September. The US and China tariff pause for 90 days and Powell won't cut rates until the US-China trade deal is made. Very good question. So my thesis actually is based on the fact that they will find a tariff compromise sooner rather than later. I've always said, if Graham, if you're in our VIP community, you would see my macro game, my macro updates, and the macro updates have been absolutely spot on so far. One of the main reasons is this: Trump and the tariffs are the anomaly. So could you just imagine, from a logical standpoint, if Trump wants these rate cuts done, and they know that Powell is saying, I need to see the data on the inflation, labor market, and all of that nonsense, wouldn't they just cut? Wouldn't they just give Powell what he wants in order for him to cut? It's a simplistic argument, but I do believe that the longer we go into the year, the more the ball falls into the court of Donald Trump and his administration. Don't forget, this is not a Fed-created crisis. The tariffs, if Donald Trump came in eventually, and didn't cause the tariffs and all of that, I think we would have continued as normal. So these tariffs are the anomaly, and I do believe they can remove the tariffs issue at any given moment. And I don't really believe that they'll wait for another 90 days to do a deal with China. I do believe it's all rhetoric, and they'll find a common ground in between. Cut rates and then boom. In Belta in the building, my sister there from the Netherlands. Hope you are doing well. And of course, from $40 to, yeah, that's insane. Cockroach hasn't, to be honest, Kevin, it's a good question. Cockroach hasn't really taken off, in my opinion, due to the fact that some of the Cockroach listings have not been done yet. So notably HTX, it's at $12.6 million market cap. It's something that I'm willing to roll on to a better time of the markets, a good few weeks run of ETH uninterrupted, an exchange listing of Cockroach, because the community is very, very strong. So I do believe that this has plenty of life left. Just never really got going above $30 million. So I like to normally look at this metric in the sense of the market cap here. Look, all-time high 25, again 25 million on this chart. Again, it came back to 21. So it seems to find this area of resistance, that $25 million to $30 million market cap. I think once it smashes that, Cockroach will do very, very well. I think it's an excellent meme coin, in my opinion. But it's just, when it's dipping, guys, the dips and all of these kind of small corrections in any token, as long as you believe in it, I think it's a good sign for you to DCA into, so many different cryptocurrencies. Even, I would say, even the more established cryptocurrencies, they're all dead. Like right now, if you look at, for example, let's look at Ether, right? Let's have a look at Ether, ATH. The state of Ether, I mean, could you imagine the market cap right now? I mean, look at this. So the market cap went as high as what? 462 million? Like literally 462 again, 483. And it's done that several times. But price, if you look at the price here, the price has been very, very disappointing. This is arguably one of the best deep in cryptocurrencies. It still lacks exchanges, right? So if you look at something like Ether, it's only available on places like, OKX is probably the best exchange it's on. The rest of them are way smaller. And you're thinking this is apparently one of the best deep in projects, but what's going on? Well, there's a lot of inflation from the checker notes, number one. Number two, the deep in narrative hasn't really taken off. If you look at partnerships and all of the things that it's got going for, there's a lot, right? There's a lot that's happening for this particular cryptocurrency. They've got an amazing treasury. They've got a lot of money. They've, good founders. Check. But price-wise, it's been absolutely awful. One of the reasons for that is purely because the narrative has been absolutely dead. The project has inflation. I was always hoping to sell Ether no later than October due to unlocks, and that remains the case. So they better get moving on. But I would say Ether right now is completely undervalued, in my opinion. It is completely undervalued. But that just shows you that's one project amongst 43 million cryptocurrencies, and none of them doing anything at all. Can we have a look at Yi? Yes, sir. I actually initially picked up Yi on Nansen. on smart wallets. But let's have a look here. Is it the one on Solana you're talking about? So have a look at the one on Sol. Sorry, on ETH. So Solana, what is that? 2.2 million. I think this is the one you're talking about. Yeezy. Oh, sorry. Actually, no, it's not Yeezy. It's the Yee token. This is it. Wrapped ETH getting sold right now. Getting sold right now. Yeah. So this is it. Let me know if this is the one. Probably mean the Legend of Yi. And it is the dinosaur ran by a community. Pepe Doge Yi. Yeah, it's coming down a bit. It's going to come down a little bit. Boom. But yeah, guys, anyway, how long we've been on? We've been on till forever, really. So again, thank you for the turnout. Has been an amazing live stream covering everything. I have no emotion for the market, to be honest. I just hope that you'll stay in and you take advantage of any good deals that come out, because boy, oh boy, the next 3 months after that will be defining, and ultimately we will be exiting the market at some point, hopefully before 2025, because I can't stomach being here deep into 26. I think that would be very, very torturous, guys. But anyway, smash a like, guys. Share the live stream. It's been an amazing stream. Thank you for your support, and I'll catch you on the next live stream. Take care.